Hi, I'm Grant Stevens.
And I'm Chris Bernier.
And we're the two investment guys. This week, Chris and I want to talk a little bit about the markets again. First, if we'll kick it off with indice returns from around the globe. We get Toronto's up about 3% so far this year versus the Dow, which is up about 16%. I look to Europe, we've got London up 9%, France is up 15%, and Germany is up 14% so far this year. So a little bit of a mixed bag. Canada's the global laggard in the world that we watch. It's a heavily commodity influenced market. The commodities have been strained somewhat this year. When we turn to what the market is fretting about at the moment, the biggest issue on the screen right now, Chris, is probably this U.S. government shutdown.
That's right. When we look at the government shutdown, essentially they've shut down all non-essential services. So basically the government has run out of budget funds and they've not come to any agreement to provide any temporary measures. So they've had no choice but to temporarily shut down government. When we look back through history, this has happened 18 times since 1976. It happened 3 times in 77, twice in 82 and 84, and the last time we saw it was in 95. So it's nothing new. And what we found through history is it was really a non-event as it relates to capital markets.
Yeah, interesting. When we looked at it, 50% of the time the market was up during the shutdown, 50% it was down, and it wasn't very much. So, you know, although it seems on the news wire to be a huge issue to capital markets, in the end it really doesn't amount to much. It's always been resolved as well, obviously. So we wanted to turn to another issue here that's a little bit tied to that, and that's the debt ceiling in the U.S. that says we're gonna get there here in short order. The debt ceiling is a statutory limit on how much borrowing the U.S. government can do, and it needs to go back into Congress. Once they get to that limit, it's kind of like the credit card thing, Chris, where somebody needs to go back to the bank, the credit card. Some would say that's a sad state of affairs if that's where we're at with government spending, but nonetheless, that's where they're at.
Yeah, exactly. If we look at the debt ceiling, it's set at 16.7 trillion. Seems like a really, really large number, and it is, but we need to remember the GDP of the U.S. annually is just under 16 trillion, so you know it's a very large economy. If we look at back through history here in May recently, the Federal Reserve, which has been buying bonds to the tune of $85 billion a month, both treasuries and mortgage-backed securities, in an effort to keep interest rates low, translated or tried to attempt to forewarn the market, if you will, that they were going to start to taper. In a sense, what we saw was bond yields rise, that forced mortgage rates up, and we saw a corresponding slowdown in the housing and the mortgage sector in July and August. So what happened in September? Well, the Fed backtracked a little bit and said, well, we're not going to taper just yet. So it's just another attempt to kind of manipulate interest rates and the market.
Right. Not sure that that plan went according to plan with the U.S. Federal Reserve having to backstep a little bit on that. Markets don't like it because it presents uncertainty, and uncertainty yields itself into volatility. We always work through these issues, Chris, and I think it's something that investors need to remain focused on.
That's right. You got to look through that short-term noise and keep focused on the long term. I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. Chris and I will continue our discussion around market issues. So until then, I'm Grant.
And I'm Chris.
And we're the two investment guys.